Buy and hold is a fairly simple strategy. You essentially buy something and you don't really have an exit plan. You just wait and hope it will go up over time. And maybe that's 5 years, 10 years, 15 years. Since you don't have an exit strategy, you really don't know how long you're going to hold it for. And so the plan is just to buy it and then wait. Active management, on the other hand, is a lot more involved. You've got to monitor all the different data that's coming out of the market, and then you've got to adjust to that accordingly. And that requires day-by-day management. Not that you're trading every day, because you usually aren't, but it requires day-by-day management. And that just is, I mean, in one scenario, you can basically put your client into a buy and hold strategy and go golf. In the other scenario, you're actively watching the store, watching that money. I believe that people get a false sense of security in good markets with buy and hold. If you go back to the 80s and the 90s, those were periods of time when the market just pretty steadily drifted up with a few corrections along the way. And when that was happening, a rising tide lifts all boats, and so a lot of stocks went up over time using a buy and hold strategy. But when you get into a period of time like the 70s, when you've got a sideways market, or 2000 and 2009, when you had some big bear markets and then a lot of sideways action, buy and hold doesn't really work out. And that's when people start to question it and start to see it for what it is. Just to really look at buy and hold over the last decade, for those people who have followed it, the market hit, or not the market, but the Dow hit 10,000 back in March of 1999. It hit 10,000 again in October of 2009. So for that entire period of time, over 10 years, those investors' accounts have really gone nowhere. And they've even gone worse than nowhere. When you factor in inflation, they've actually lost money in those accounts following buy and hold. And that's talking positively about the Dow, painting a positive picture. The Dow is just 30 of the largest stocks in the U.S. The NASDAQ, which is a much broader measure of the U.S. market, it's 6,000 stocks. It hit 5,000 back in March of 2000, and by October of 2009, it had lost 57% of its value. So the question is, for those people who are buying and holding, and now they're sitting on a 57% loss after 9 years, how much longer are they supposed to sit there and wait? Here at Paragon, we're definitely advocates of active management. We manage our portfolios, our growth portfolio we've managed since 1998 using an active strategy. That portfolio is up 348% from January of 98 through October of 2009. By contrast, the S&P 500 during that same period of time is up about 39% over that same period. Our active strategy is almost 10 times the amount of the S&P 500. I don't see how you can make an argument against that. Whenever I give numbers, I have to say that past performance is no indication or guarantee of future results. And that is true. But I invite you to go to our website, where each month we update our information on our track record. And you can see our numbers, and you can evaluate them for yourself.